When there's weakness in the tech sector, it really hits the US market. We're in a very concentrated US equity market. So I think that's part of it. People are looking to diversify beyond the US.
All right, joining me will be Craig Abilene, head of ETF Strategists at Fidelity Investments, who of course is a top 10 ETF issuer, currently 75 ETFs, about $150 billion in assets. And Craig sits in a very interesting role because he works with Fidelity's portfolio management team, their product development team, and their distribution team to help educate Fidelity clients on ETFs. And so that obviously places him in the perfect spot to observe and analyze key ETF trends. And that's exactly what we're going to discuss this week. I'm calling this sort of an ETF State of the Union because Craig is going to highlight some of these key trends and themes that he is seeing right now and offer a few thoughts on where he thinks things might be heading as well. And I'll tell you, he has some data regarding financial advisor ETF usage that I'm really interested in hearing more about because we know how big of a driver financial advisors are in dictating ETF flows and trends. And so we'll get into that as well. This should be a great conversation, again, with somebody who knows the ETF space inside and out. Now, to start this week, I'll be joined by Roxanna Islam, head of sector and industry research at VettaFi. And speaking of key ETF trends and themes, a very big one right now, which I'm sure I'll touch on with Craig as well, is the growing interest around international equity ETFs. This category actually just took in record inflows in January. And I was looking this morning, February is already off to a fast start. And of course, this follows record inflows last year. And so Roxanna and I are going to dive a bit deeper into this story. She has all of the latest flow data around international equity ETFs. We're going to discuss what's been driving the outperformance in international stocks over the past year or so, which of course, that has helped drive those record inflows. And then we're also going to open up the ETF toolbox a little bit and spotlight a handful of ETFs outside of the big, broader-based ETFs that most of you are already familiar with. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let's start this week with VettaFi's Roxanna Islam. Roxanna, always a pleasure. Thank you for joining me.
Yeah, thanks for having me, Nate. Always great to be here.
So do you like this recent shift, being able to talk about international stocks in a positive light after years and years and years of them being in the gutter? I feel like it was always so negative on here when I would cover international stocks. I felt like I was always talking about why they were underperforming, when they might turn around, if ever. I feel like this is a nice breath of fresh air, at least for me. How do you like this?
No, it's definitely interesting to talk about something new and a new sort of regime shift that's happening here.
All right. So international equity ETFs, they really started to become a bigger story last year. I just noted how 2025 was a record year for inflows into the category. But this momentum has clearly carried over into this year. And I guess to start, do you want to offer some of the flow data you have here just in terms of what we have seen over the past 13 or 14 months?
Yeah, Nate. So it's been very interesting seeing all these net inflows go into these international equity ETFs. When domestic equities were had sort of taken over for several years prior to that. So in 2025, as you said, there were some record net inflows. There were around 220 billion or more in net inflows that year. And this year, we're already seeing significant strength, around 75 billion year-to-date net inflows. So that's been some sustained demand for this exposure over the past, year or so. If you look at some of these specific products and see exactly where advisors and investors are allocating, it's pretty interesting. If you look at broad international, excluding US, so VXUS, for instance, that saw about 9 billion so far year to date, pretty significant there. Developed markets, VEA had about 3 billion, IEFA had about 1.5 billion. Then when you look at emerging markets, that's where it really gets interesting because it's some pretty impressive net inflows here. So IEMG had taken in about 10 billion net inflows year to date, and EEM about 4 billion. So that's really some significant strength in emerging market over broader international. And if you look at the entire US ETF universe, which is about 5,000 or so ETFs now, and you rank them by year-to-date net inflows, IEMG is number 2 and EEM is number 9. So that's some pretty impressive net inflows for emerging markets.
Yeah, these international equity ETFs, and to your point, emerging market ETFs in particular, they're all over the ETF leaderboard. And as I mentioned earlier, obviously performance has been the big driver here. We know that outperformance typically leads to ETF inflows. And actually, let me give a few numbers here just in terms of performance. So if we look at, say, IEFA, which you noted, that's the iShares Core MSCI EFA ETF, Developed International Stocks. That ETF is up 44% since the beginning of last year. If you look at IEMG, which you noted as well, the iShares Core MSCI Emerging Markets ETF, that's up 48% over the same time period. And if you compare that to, say, IVV, the S&P 500 ETF from iShares, that's up about 18% over that same time frame. And then if you run the numbers just year to date, IEMG is up 12%, IEFA 9%, and then IVV is flat. And so, the point is that this outperformance that we saw last year has carried over into this year, along with the flows following that. And so I'd love to have you maybe talk about what you view as some of the drivers here. You're a CFA, so you get deep in the weeds on this stuff. So maybe put on your investment hat and tell us what you think has driven this outperformance.
Yes, I mean, first of all, it is diversification away from the US. That is a big part of it. We've seen many times already, when there's weakness in the tech sector, it really hits the US market. We're in a very concentrated US equity market. So I think that's part of it. People are looking to diversify beyond the US. But obviously, there are some more fundamental drivers underneath these trends in international. One of those is the US dollar. We have seen a weaker US dollar since the beginning of 2025. It's been down around 10%. And that is a real tailwind for international exposure, especially from a US investor perspective. On the international side, there are also regions that are showing pretty strong economic growth beyond the US. So Europe, for one, has been showing some pretty good strength in defense and infrastructure. We've all heard about some of the strong spending plans in several of the European countries. That's helped improve, earnings expectation and investor confidence in the European market. And we're seeing a similar thing happen in Asia with technology. So, there's plenty of strong country and regional growth stories. And I think from a valuation perspective, even after we've seen the outperformance in international equities, they're still pretty cheap relative to US markets. So I think that's sort of a big point there. So if you look at it on a 12-month forward PE basis, international is trading at around 18 times relative to 22 times in the US. So, not just a significant growth potential there, but also at a relatively cheap value.
Yeah, and on valuations, it's funny because I talked about how I've covered international stocks for so many years and more in a negative light. And one of the things that I would always talk about is how valuations were more attractive in international equities in the US. That's been the case for a long time. And we know that typically valuations, they're not very good short-term market timing tools, but they can be very good longer-term, if you want to call them timing tools. And I do think that's something that is driving a lot of this interest right now, just because there is more concern around valuations in the US. You mentioned the diversification trade away from the US. And so, of course, if valuations look more attractive, that's going to be something that investors and advisors look at. And then you combine that with some of the other factors that you noted, the weaker dollar, which I do think is a really big one. I think that the weak dollar, if you look at the correlation between a weaker dollar, and then the outperformance of international stocks, that typically always holds. So I think to your point, there's a lot of things that have come together, but the fact that valuations are more attractive overall, certainly is like the icing on the cake here. With emerging market stocks in particular, are there any other drivers that you would point to outside of what you just mentioned, or is it really the same story, just in terms of the weaker dollar and more attractive valuations, et cetera?
So I would say it is largely the same story, but on a more significant basis. So the emerging market story is a pretty high growth story, actually. In periods of growth, they do tend to grow faster than developed markets. So there could be some higher, upside potential and earnings catch up there on the emerging market side. And I did mention the US dollar. A lot of emerging market countries, they actually borrow in the US dollar, which makes the weaker US dollar more beneficial to these countries. Also, in terms of individual country standouts, I think on the broader international side, I mentioned Europe, but on the emerging market side, there's several different countries that have stood out in terms of performance and outlook. Korea is one of them. Taiwan is another. They're both major players in that AI tech supply chain story that's happening in Asia. So there's been some pretty strong growth there that has actually contributed to the overall international story. And then, going back to valuations, when you look at emerging markets, they're actually even cheaper than broader international. So they're trading at about 14 times 12-month forward PE.
By the way, on your point on Korea, if you look at South Korea, have you seen the performance differential between IEMG and VWO, the Vanguard Emerging Markets ETF? If you go back to the beginning of last year, IEMG has actually outperformed VWO by 13% or so. And if you look under the hood, a big reason for that is because VWO doesn't have any exposure to South Korea, because Vanguard, or I guess the index they're using, FTSE, they consider that a developed market. I guess my point being, that's another good reminder to look under the hood of whatever ETF you're using, or look at all your options out there, which I guess on that note, we've talked about the flows into IEMG and EEM, basically investors flocking towards some of the biggest emerging market ETFs out there. But there are other ways to access emerging markets through ETFs. And I'm curious, are there any in particular that stand out to you right now? Again, just beyond the most popular ones that everybody looks at.
Yeah, and I'll mention a few, but there are actually a lot, like you said. So if you look beyond the large iShares and the large Vanguard products, there's well over 100 of these, and it doesn't even include single country ETFs. These are just emerging market ETFs. So very interesting there. But I did want to bring up a segment that was pretty interesting to me in terms of performance. I guess I'll call it democracy tilted emerging market ETFs. Although all of these, they sort of have a different name for it, and then they define their methodology differently. But across the board, it's sort of the same, basic idea that countries with higher human rights or political freedom have a better chance of growth and success. So I'll bring up 4 ETFs, and I'll name those in a second. But 3 out of the 4 of those ETFs actually have had performance over 50% in 2025 compared to broader emerging markets, which is in the high 20% to low 30% range. So very significant outperformance last year. And so far this year, all 4 ETFs are returning high teens to low 20%, while broad EM is in the low teens. So still that outperformance continues. So I'll talk really briefly about these 4 ETFs that I see in this category. So the first one is the Freedom 100 Emerging Markets ETF. That's ticker FRDM. Freedom, great ticker there. This is actually very surprising to see that how large this one is. It's actually around 2.7 billion in assets. So pretty significant there. It uses quantitative personal and economic freedom metrics to select and weigh its holdings, and it avoids autocracies. You also have OAEM, which is the 1% Emerging Markets ETF. Similarly, this ETF uses some proprietary value-based screening to, select investments that will make an impact on the world. They also exclude companies that could potentially harm their stakeholders, and they have some strict policies and guidelines for investing in China as well. First Trust actually has two that are actually pretty similar under the hood. It's FTHF and EMDM, and they both use guidelines and scoring from a nonprofit called Freedom House to select and weigh their constituents. So FTHF uses something called a human dignity score, and EMDM uses something called an electoral democracy score. So essentially what these all end up looking like. So you apply their individual methodologies and it becomes, something that's heavily tilted towards countries like South Korea and Taiwan, which I already mentioned have performed really well recently due to their tech exposure. And that's definitely contributed to some of the outperformance of these ETFs relative to broader EM. And also, interestingly, these ETFs have no exposure to China. In contrast, if you look at some of the ones I mentioned earlier, like IEMG or EEM, they have close to 25% China, and that's their top geographic exposure. But I will add that it's not the same as an emerging market ETF ex China, because there's a bunch of those out there. These all have proprietary weighting methodologies, so there's other significant differences. I'll point out Freedom again. So the Freedom ETF, its second largest geographic exposure is Chile, which it has 18% in. That country has less than 1% exposure in both IEMG and EEM. So, we're talking about significant difference in weightings with these methodologies. It's not just something that excludes China.
Well, and I think that it goes back to what I was saying earlier, just with VWO and IMG, and that you have to look under the hood. And I think if we continue to see emerging markets run, there is some real opportunity here for outperformance, because there are some very interesting products on the market. The ones you walked through, I think, are excellent examples. Which, by the way, I have to note the Freedom ETF. I think as I look back on like the last however many years, 5 to 10 years, that's one of my favorite ETF success stories. I don't know if you've ever talked to Perth Toll, who's behind that, but this is somebody, an entrepreneur who could not be more passionate about this Life and Liberty Index business that she put together. And then that ended up turning into this ETF, and to see it with whatever you said, $2.7 billion in assets. I absolutely love that. But I think there's a fairly long runway here, going back to what I was saying, that if we continue to see outperformance from emerging markets, you're going to have a bigger pool of investors look at these products. So it's really interesting. You mentioned a single country ETF. So let's say investing directly in, say, South Korea or Taiwan. Are you seeing any uptick in interest or inflows around these types of ETFs? And I guess, how do you think investors should think about allocating to single country products?
Yeah, so there's been a bit of interest in single country ETFs like Korea, and then Taiwan is another one I mentioned earlier. Korea in particular has seen some significant interest since last year, and it's largely due to performance, as we mentioned. Pretty impressive. I actually wrote a note on it earlier this year, but if you look at the largest Korea ETF, which is iShares EWY, it's actually up over 90% in 2025. And so far this year, it's up 38% year to date. But it's interesting, you said look under the hood a few times already in this conversation. So if you look under the hood of this ETF, it was a little bit surprising to me the first time I did that, because it's very heavily concentrated in just a couple of stocks. So, and they happen to be semiconductor stocks. So Samsung and SK Hynix, they make up almost half of the ETF's weight, 47% of its weight. So it's doing well because of these two stocks, but that is a lot of single stock risk within an ETF. It's a similar story when you look at Taiwan. iShares EWT is the biggest, and that's up around 15% year to date. It has about 25% exposure to TSM, which is another semiconductor stock. So just a lot of concentration in single stocks when you look at these two countries. So it's a little bit ironic. So if you are trying to avoid some of that AI and tech over concentration in the US, I would just be aware that it's sort of a similar story on the international side with some of these countries like Korea and Taiwan. Their economic story is very heavily dependent on the tech and AI story as well. Although I will mention with Korea, I have been seeing some other tailwinds sort of emerge. It's pretty interesting because last year we actually saw two new Korea ETFs launch. Actually one new Korea ETF and one that has a significant exposure to Korea. And they're in the defense space. Defense is growing not just in Europe, but also in Korea and Asia. So, one of the ETFs that was launched last year is ticker KDEF, KDEF. And that was launched by actually a Korean asset management firm called Hanwha. So that's up about 30% so far this year. So not insignificant at all. Wisdom Tree also launched a suite of global defense ETFs, including WDAF. So that's the Wisdom Tree Asian Defense Fund. So not particularly Korea, but Asian defense. And it does have a large exposure to Korea. It's actually 44%, so almost half of the ETF weight. So some interesting growth avenues there outside of tech, but it's still largely a tech and AI story with these.
Which again, look under the hood. Your colleague Todd Rosenbluth is going to be so proud of us for saying "look under the hood" like 18 times on this episode. It's just, his tagline. Roxanna, just a few minutes left here. If we come back to the bigger picture, so I think I do these 5 ETF predictions every year. And one of my predictions for this year is that international equity ETFs would smash their record inflows, which I'm obviously feeling very good about that at the moment. But what type of opportunity do you see here moving forward? Like how big of a shift could we ultimately see? And let me caveat that by saying I'm not expecting, say, the Vanguard S&P 500 ETF to be supplanted from the ETF leaderboard or anything like that. I think we're going to continue to see flows go into products like that. But what type of runway do you think is here for international equity ETFs moving forward?
Yeah, I think it's some significant growth that we can see, especially given the flows that we've already seen so early in the year. I think we could easily beat some of the records that we saw last year. If we assume that investors were already underallocated to international, particularly emerging markets, I think flows will continue to follow performance as they sort of catch back up this year. And, some of the tailwinds that we talked about are very important. And I think it's mainly that overconcentration in U.S. equities and U.S. large caps, especially since we've seen some early market reactions to tech weakness already this year. I will say I think there's still some reluctance to invest in internationally, even after seeing some of the performance this year and last year. We had a December market outlook symposium here at VettaFi where we had a survey where we asked advisors, what they thought was their biggest barrier to increasing client allocations to international equities. So only 17% said there were no barriers to increasing. Things like geopolitical risk and currency risk were only 20% and 7% respectively. But actually the largest answer choice was long-term performance versus U.S. equities is holding them back. And that's 44% of them actually picked that answer choice. So that was very interesting to me. And I think as, these performance trends continue, obviously we'll see some flows follow. And I imagine if we ask that again at the end of this year, that 44% number would be significantly decreased.
That's great data. And I think that aligns with just how I view things. I've talked about this before, but the way that I would lay this out, if we go back over, just say, the past 10 years or so, particularly financial advisors, because of the underperformance of international equities overall, they continue to slowly overweight towards U.S. equities. And I think there was a real home bias to where if you looked at the composition of portfolios, say, in 2024 or 2023, they were way overweight U.S. And the reason for that is if, let's say, in 2015, you were an advisor that had, I don't know, Roxanna, 30, 40, 50% of your equity exposure in international, guess what happened? You started getting really nasty phone calls from your clients or nasty emails saying, why are we underperforming so much? I see U.S. stocks running ahead. We own all these international stocks that are basically dead money. And so the incentives for advisors were. The incentive was basically to get out of those international equities and continue to overweight US. And I think that's what they did. And I think certainly even on the retail side, we saw a lot of that where retail investors just continue to pile into what's working. But now that we do have this period of outperformance, and it's still early, right? We're talking about a year and a half of outperformance. That's very short term in my mind. But if it continues, you're going to have the same dynamic with advisors where ultimately clients are going to start asking, why am I underperforming? I see international stocks running ahead and we're overweight US stocks. Like I said, this year we're flat so far. And so I do think there's some real drivers there. I think there's a powder keg that if this outperformance continues, we're going to see monstrous flows into international equity ETFs. So point being, a long-winded way of saying I agree with everything that you noted there, and that aligns with the data that VettaFi has. And I agree, if you take this poll, say in 3 months or 6 months from now, you're going to see a change there, unless international equities just fall off a cliff. But in any event, Roxanna, I always enjoy hearing your perspective. Excellent insight as usual this week. Thank you very much for joining me.
Thank you, Nate. Great being here.
That was Roxanna Islam, head of sector and industry research at VettaFi.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by Craig Abilene, head of ETF Strategists at Fidelity Investments, who currently offers 75 ETFs, about $150 billion in assets. Now, of course, Fidelity is one of the largest asset managers in the world, over $16 trillion in assets under administration. But Craig stays on top of all of the latest ETF trends and data, and he is now joining me from Charlotte. Craig, welcome back to the podcast. Great seeing you again.
Yeah, you too. Thanks for having me.
Okay, so I've got to tell you, I'm really looking forward to this because we're going to do sort of an ETF State of the Union this week and walk through some of the key ETF themes and categories that are really driving investor conversations right now. And I thought a good place to start would be to at least briefly look back on 2025, because I know you have some ETF flow data and specifically some financial advisor related ETF flow data, which I'll tell you, I'm very interested in hearing more about that because we know financial advisors are such a huge driver of the ETF market. But I thought I'm just going to give you the floor here. I'll just say that, we know it was a record year for ETFs last year. We know actively managed ETFs continue to be a massive story, which that's obviously important to Fidelity's ETF business. But just give us a recap of what stood out to you in 2025.
Yeah, absolutely. I mean, we look at the overall market and ETF trends, but it's also really good to understand what financial advisors are doing, how they are putting money to work for their clients, and some of the key differences there is super interesting to me. But as we know, 2025 record year in flows, over 1.4 trillion in overall flows, but about 36% of that was going towards active ETFs, bringing the total active ETF AUM to 1.5 trillion, which is roughly about 11% of the overall ETF assets. So only 11% of overall assets, but growing really quickly, 36% of flows. And you're just seeing a proliferation of new strategies, right? Last year, we saw over 1,000 ETF launches. About 889 of those were active. So the majority of new strategies coming to the market are active. And then you've seen over 300 launches or over 300 new ETF issuers over the last 3 years. And that's just more ETFs, more people playing in the space. But what's interesting when you look at the advisor market, when we see overall, I mentioned 36% of the flow is going towards active. In the advisor space, financial intermediary space, it's about 47%. So almost half of the fund flow is going towards active strategies, meaning financial advisors are using those new tools that we've seen over the last few years since 2019, using those new active ETFs as a part of their portfolios and growing momentum really, really quickly.
Okay, so several things I want to unpack there. First, I'll ask you, just with the increasing interest in active ETFs, if you were to drill down further and look at specific categories where active ETFs are taking market share, are there any in particular that stand out?
Yeah, I think last year was an interesting case because you had that dip kind of between February and April, and you saw like net ETF flows were kind of muted. It was actually the lowest fund flow month of 2025, but you had the highest volume. And so I think it was an opportunity for people to reposition their portfolio, and some of those buying trends have kind of continued through the end of the year. And you saw a shifting in categories. So more buying of behaviors, exposures, advisors were moving more towards the broadening theme. So more magnitude and conviction versus the rest of the market towards large value, small, mid, international, maybe areas that they were underexposed to or underweight to in 2025 or 2024. And then significantly going active in those areas. Areas maybe that could be considered less efficient markets, going active, trying to get an edge there. And then in fixed income, we saw a move. The story of the last couple of years has been short term or ultra short term. Saw a move more towards core plus, and using active in that space. And then I think the final category that surprised a lot of people last year, but was super interesting, was derivative income, using options-based strategies to get market exposure, but adding on an income layer. Those just exploded. Were the fourth category overall of incoming flows in the advisor space, and then overall was up there as well. And so interesting use case, but some categories that maybe have flown under the radar over the last few years, dominated by large blend, and large blend was certainly a big part of the picture this year. But you're starting to see some of those other categories gain momentum, specifically in active as well, and with financial advisors.
You gave those stats earlier that show the higher level of active ETF adoption among financial advisors. I'm curious, why do you think that is? Like, why are financial advisors a little more comfortable with active ETFs than the general population of investors? And obviously, the category is growing tremendously overall, but why is it growing even faster among advisors?
Yeah, I don't think it's new to them, right? Like if you look at who's winning in that space, it's a lot of the traditional active mutual fund managers that now have ETF options. And it's a combination of advisors having existing relationships with those active managers for decades, likely. And then two, they have the tools, right? Whether it's an independent broker dealer or a wirehouse or an RA, they have the due diligence tools and have for a while, and have the know-how, the technology, and support to be able to discern between skill versus luck, right? And pick a active manager that's going to deliver what they want. And I think that expertise there is a value add that they can bring, and understand kind of the value of, hey, you might need to pay a little bit more for an active strategy, but I know what I'm getting out, and I know how to evaluate the 1,000 new active ETFs that there are. They should have the tools to be able to say, hey, this one is going to give us the exposure, or is going to give us the right return versus risk reward, kind of risk versus return reward that we're looking for our clients, because they've been doing that. And it's a value add over maybe doing it yourself, right? Because we see less adoption in the overall retail market.
You mentioned perhaps having to pay more for an active strategy. One of the things that I know very well about many financial advisors is that they do focus on investment costs, right? They're looking at fund fees. And we know on the whole, active ETFs are more expensive than passive ETFs. I'm curious, in the data that you look at, what are you seeing on that front? Like, are there any clear fee trends that are emerging as we've seen this active ETF adoption?
Yeah. I think when you look at passive, it's still, 83% of active flows are going to 20 bips or less, right? Like it's still, if you want beta, market exposure, passive exposure, you want to be conscious of cost. To your point, like as you go active or move towards higher active share, depending, there's many variations of that from low active share to high, you're willing to pay a little bit more as long as the reward's there. But in the advisor space, it was kind of interesting looking at some of those trends versus retail versus kind of the overall. Overall for advisors, the sweet spot was about 20 to 40 basis points for active ETFs. So 46% of the flows were going there. The second was 40 to 60, about 25%, which mirrored overall a little bit. The biggest difference was in the overall market, about 20% of flows were going to ETFs that had an expense ratio of 60 basis points or more. So really, typically kind of expensive for an ETF land, right? 60 plus basis points is considered more on the expensive end. In the advisor space, you saw a lot less of that, right? It was only about 14% was going to that 61 bip bin. And very different use cases, I think. You saw some interesting things in that bin, but you can tell based on the data that advisors are fee sensitive for their clients, their fiduciaries, but there is a sweet spot where that active ETF adoption is growing, and it seems to be that 20 to 40 basis point window. Everything outside of that doesn't seem to be trending as much.
So with that in mind, who are the types of ETF issuers that are primarily benefiting from this rise in active? And I know obviously Fidelity had an excellent year with its ETF lineup. But in general, what does a successful active ETF issuer look like right now? Fees clearly are a part of that, I would think, being competitively positioned. But what else?
Yeah, I think you've seen a couple areas. One is where there's value add active strategies, right? Where you have a demonstrated track record of expertise, where you have a track record, whether it's the portfolio management or the firm has been known as an active manager. And you're seeing a lot of those firms that are being adopted in the active ETF space. And a lot of that is because those are the firms that are putting resources towards their ETFs, right? They've built out an ETF team or have had one, Fidelity specifically. We've been in the ETF space for over 20 years, been active managers for over 80. So it was a natural transition to be an active ETF manager because you have the technology, the piping, the people and know-how to make that happen. And those firms, and that seemed to be a trend of what's growing, is firms that are putting the resources. It's not, we use the term a lot of like ETF tourists, where they're like, hey, we'll throw some ETFs out there and see what happens. And Bill from accounting, 5% of his time will be on the ETF team. Sally from ops, 5% of her team will be on the ETF team. It's the firms that really build out a dedicated ETF space and are tourists. And then I think there's kind of two types of strategies that are, at least in the equity space, we'll start there, that are gaining a lot of steam. It's high active share strategies that have a demonstrated track record of success. So I think about our blue chip growth strategy, which has been a mutual fund for decades and has incredible success in that space, beating its benchmark. That's gained a lot of adoption. And then I think where you see additional adoption is maybe lower tracking error active, where more systematic active equity strategies that are looking to look like the index when it comes to maybe tracking error, kind of a risk profile, but using the active ETF vehicle to be more discerning with what they own, trade actively. And we're seeing that with our enhanced strategies, our enhanced ETFs. And then on the fixed income side, it's categories, right, where you think you can add value. So we're seeing a lot of traction in municipal bonds, core plus bonds, intermediate core plus strategies are growing significantly in the active space. And then third is options-based strategies. You need to be active if you're managing options to be able to react to market conditions. So in the hedged equity space, in the derivative income space, getting yield, we're seeing a lot of growth of traditional active managers bringing strategies to that space. And I think it's because of the long-term expertise and then applying it to a vehicle that we have some experience and dedicated teams to.
When you look at the flow data, it does seem like investors and advisors are piling into the largest active ETFs and the largest active ETF issuers. Do you see any downsides to that, or is that just the way it goes, right? The big get bigger, they have the resources, the experience, and maybe investors feel more comfortable with these larger issuers. And to be clear, I think we've seen adoption across the spectrum. There are certainly smaller issuers that are doing very well, but if you just look at the flow data, it's clear that investors are gravitating towards those largest issuers. I'm just curious, how do you think about that?
Yeah, I think it's the classic like assets beget assets. So there's that piece of it. A lot of times, the largest active ETF issuers and largest ETFs are playing in some of those like Morningstar style box, like big box categories that attract larger flows. But you're seeing more and more strategies launch, and I think when you're seeing some smaller, maybe issuers launching more niche products, but those are also being used as well. They're just not as big of a piece of the portfolio. They're getting a lot of new clients and bigger, diverse client set, but maybe if you think of a core satellite type model approach, they're getting the satellite positions, not the core. But you're seeing more and more, I think, again, you saw 300 new ETF issuers over the last 3 years. You're going to see more and more competition, and I think you're going to see dispersion of that allocation of the top 10. Right now, I think it took in like 63% last year of the top 10 ETF issuers took in 63% of the flows. I think you'll continue to see that number come down as there's just more options and more strategies out there and more issuers.
Okay, so with all of that as the backdrop, let's talk ETFs this year. I said I want to do sort of an ETF State of the Union, so I think we've set the table pretty well here. And I guess let's just stay on the topic of active management. This is going to continue to be a huge story. I'm assuming that you're going to tell me you don't see active ETF adoption slowing down. Is that a fair characterization?
Yeah, I think in the areas, it just is going to continue to grow. I think it's a technology change. The way that I describe it is kind of, and depends on what city you're in, I guess, but Uber versus taxis, right? Taxis were great when you're traveling. I travel all the time for work. When I travel for work, I would come outside of the office, call a cab, whatever. But there was a technology change. We have smartphones. I can now go on my app, schedule an Uber or Lyft for when I need to get to the airport or get to a meeting, and it's there right on time. And that was a technology change. I think of that same thing in terms of the shift from passive to active ETFs, where there was a rule change. There was a dramatic change in the way that you can manage these ETFs, and going from passive ETFs were great, and I've had plenty in my portfolio. But now, there's this shift where, hey, I don't have to track an index. I can trade actively. I can be a little bit more discerning with what I own, and I can determine the risk profile, from lower risk, market-like risk to higher risk, higher active share. I can really dial that up in my ETF vehicle as I want. And I think advisors see that value add as well. And so as a result of that shift and that rule change, I think you're going to continue to see in some more recent legislation with rule changes with the share class, continue to see that adoption grow and grow.
Okay, you mentioned the share class, not me, so I'm going to follow up with a question on that. I know Fidelity is pursuing that. I'm not sure what you can comment on specifically regarding that, so I won't ask you that. I'll leave that to you. But I will ask you, do you see the ETF share class structure as an accelerant for further active ETF adoption?
Yeah, certainly. I think, broadly speaking, not just with Fidelity, it opens the doors to evaluate what strategies have existing track records and evaluate what strategies would be well fitted to have this vehicle. It's not every strategy. It's not going to be a perfect fit everywhere, but there are certainly opportunities where having an ETF share class of an existing mutual fund is going to allow for flexibility for the end investor, potential tax efficiency for them in their portfolio. But it's down to every mutual fund that you manage. Would it be a good fit as an ETF? And it's not yes isn't an answer to every mutual fund. I wouldn't expect every mutual fund to have a 1-for-1. But it's certainly, we're interested, the industry's interested, and it could be a good solution for clients. And so we're going to evaluate what fits well and hopefully, bring some products to clients.
We've spent a lot of time on the active ETF story, which I think is clearly relevant, but let's put that aside for just a moment. Are there any ETF categories, whether broad or more granular, that you think might see greater uptake this year? And I want to be clear for listeners, these aren't any sort of investment recommendations, right? Everybody do your own homework. I'm just curious, Craig, as you look at the overall investment landscape right now, which ETF categories do you think could see additional growth?
Yeah, I always tie it back to how we look at the market and our capital market outlooks and partners that I work with all the time of where we think there's opportunities and how we communicate with our clients and a lot of the research that we've done. And three areas I think are going to continue to grow, large growth. I think you have, policy as a growth catalyst, as well as some economic acceleration with the consumer. So I think you'll continue to see growth there and some productivity gains with AI. You'll continue to see growth in large growth. And so that category, I think no one's afraid of, and we've seen a ton of allocation there. Continue to see that trend. But I do think there's a strong case for diversification in small caps and international. This year alone, one of the ETFs that we're seeing is the number one ETF for us on the equity side so far this year is our Enhanced International. As we see double-digit earnings growth projected for 2026 in international developed strategies, along with a potential weakening dollar, we're seeing a lot of allocation there. And I think a lot of advisors that I work with, at least, are anecdotally are underweight international to kind of market cap weights, and so maybe getting right sized there. We're seeing some trend, and then in small caps, this is a crazy statistic. I thought it was wrong when I first read it, but the earnings estimate for the Russell 2000 next year are 41% earnings growth year over year for 2026, which is crazy. You think about potential rate cuts. And some other factors there, but that's an area as well where we're seeing a lot of potential growth. But again, two areas of the market where, I don't want to own every 2000 stock that's in the Russell 2000. We see active adoption growing there. Where, in those less efficient markets, we want to take part in that diversification play and part of that earnings growth, but selectively. And then, third, I would say is I think options-based strategies are going to continue to grow significantly, whether it's hedged equity, which we're seeing trend a lot this year, kind of providing some downside protection, give you some market, but there's some wariness, right? Using options to give some downside protection, or whether it's gaining yield if you think you're going into a decreasing rate environment, being able to lock in a healthy yield using an option strategy.
I like how on the small caps you brought it back to active management, which is clearly the theme of our conversation. Let me ask you this. Actually, in my previous segment, we spent a lot of time discussing international equities and international equity ETFs. And I think you hit the nail on the head in that. I think if you look over the past 10 years, I'm not going to go through my full diatribe that I did earlier, but I think where we have ended up today is advisors and investors overall are significantly underweight international. But we've now had this period of, say, 13, 14 plus months of fairly substantial outperformance. You look at valuations, certainly look more attractive. You mentioned the growth rates looking attractive. You have the weaker dollar. I guess two questions for you. One, what are you hearing in conversations that you're having with Fidelity clients regarding allocating to international? And then I'll tee this up for you. Talk about active management in international.
Yeah. So, if you go back 3 years, like 2024, the earnings growth, Fidelity fundamentally believes that prices typically follow earnings, and earnings growth is important to sustain a healthy price return. If you go 3 years ago, 2024, the earnings growth in international developed and the EFO was 1%. I think this year was about 6%. Next year, projecting about 11%. When's the last time you saw double-digit earnings growth in international developed? So there's certainly a case to be made that if prices follow, it's a good diversifier. As you mentioned, weaker dollar and not seeing necessarily that improve. And when there's a weaker dollar, international markets perform well. And so a lot of clients that we work with are looking at that and saying, okay, well, I'm underweight and maybe I need to be more diversified. And I think a lot of people we worked with last year, there's a handful that had a healthy diversification, but there's also plenty that weren't. And look at the returns that we saw in international developed last year, and we're like, we missed out. And so reevaluating that allocation, and we're not making the case to say, hey, be overweight international, but maybe get closer to market weights, which, anecdotally, the majority of clients I talk to aren't close. They're way overweight US, which to be fair has worked over the last 10 years. So you can't get mad at it. Clients are not mad about that. And then when we get into international markets, again, just like small caps, when you buy the EFA as an example, you get some really good names. You get some okay ones, but you absolutely get some bad names as well, or state-owned entities that aren't capitalists or trying to, their number one concern isn't getting returns for their shareholders. It's to provide a service to the people of X country and so on. And so there's a good opportunity to say, hey, I want to tweak my exposure and own the good names and maybe drop the bad ones and have the opportunity to be active and a little bit more discerning. And then the second part, I think, with the active ETF vehicle is being able to have a custom creation redemption basket and be able to react to the market on a daily basis, be able to trade actively, use the best idea today, not from a quarterly rebalance 3 months ago. And so that opportunity set, I think, gets even better when you lace in active management. And we see it on the mutual fund side with international capital appreciation has trended really great the last few years and garnered a lot of advisor or investor interest. And then our enhanced international FE&I is just exponentially grown because it provides that low risk profile with the overlay of systematic active management.
Just a couple of minutes left here. So I also wanted to ask you about derivative income strategy. So again, when I asked you about potential categories for growth, you mentioned just that large growth will continue to run. We've talked about the diversification opportunities with international and small caps, but then you mentioned options-based income ETFs. And I know last time you were on here, we talked a lot about this category. I'll just give you, again, a broad question here. I mean, do you have any new thoughts on this space? Clearly, you're expecting further growth ahead. Anything that investors should be thinking about here?
Yeah, a couple of things. I think you're going to see a lot of growth continue there. As for two reasons: one, rates coming down, people are going to look for other areas for income, and having a derivative income strategy that is options, right? It's math. We can give you a return and a risk profile of, we call it the S&P 500, while generating income through calls. Or I think, and the second piece is I think there's a lot of maybe some market uncertainty of like, hey, when is there going to be a pullback? And we're anticipating that a little bit. And so we're seeing hedged equity strategies being used. We're using puts to provide downside protection, but without taking you out of the market, right? But my one kind of caveat to that is that there's a ton of new strategies there. There are many different strategies existing and a lot of different ways that they go at it. And you're seeing some crazy yield numbers. And I think you're seeing some flow there without necessarily understanding like the risk on the other side of it. Yield isn't free, so understanding the risk, but I think doing the due diligence and understanding the underlying strategy and digging in a little bit into the options and meeting with whether it's your wholesaler or the PMs to kind of really understand what's going on. Because there's a lot of different ways that people are approaching this space and not everything's created equal, right? And not saying one's bad or good or bad, just different type of approaches. So it's really important, I think, as, when I talk to my financial advisors that I work with, it's understanding the risks that you're taking, really understanding what's going on under the hood so that your market expectations or your performance expectations are in line in different market environments. And so that's my one, I guess I could go on for another like half hour on that, but really understanding the approach, whether it's how they distribute income and how it's the tax treatment or the real risk profile, on a hedged equity, what are you actually doing? They're using calls and puts, or they're using puts, how long dated are they? All those questions that I think are important to really dig into the weeds as we see that category grow, I think are going to be important just to make sure the clients aren't disappointed, that they understand the risks.
Always wise words. Know what you own. Do your homework. Due diligence. Right. That's been another recurring theme on the podcast this week. Craig, always enjoy visiting. I thought that was a very nice tour through the ETF landscape. So thank you for that, and thank you for joining me.
Yeah, thank you, Nate. It was a pleasure.
That was Craig Abilene, head of ETF Strategists at Fidelity Investments. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I will be joined by Christian Magoon, founder and CEO of Amplify ETFs, who they just had their best year ever in 2025 in terms of ETF growth. They're now over $20 billion in assets, and they'll actually be celebrating their 10-year anniversary in April. So we're going to discuss that growth and certainly go through a handful of Amplify ETFs. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.